Hello everybody, my name is Ryan Manley. I'm with American Financial Network Dream Home Funder, and today I want to talk to you about the actual cost of your low interest rate. If you purchased a home or refinanced in the last 5, 6, 7, 10 years, you probably got a historically low rate. Congratulations on that rate. That's great. I think it's more of a water cooler brag about how low your rate year is situation than people actually understand how much it's really costing them to have a low interest rate like that. So I did a really good example here, and I'm going to run you guys through it really quick, but just some background information. Right now there's over $1 trillion in credit card debt that consumers have out there. So it's a lot of money. So people are at the water cooler saying, oh, I got 3.25, 3.5, 3.75 on my mortgage rate, great, good for you. But what they're not talking about or telling anybody is the $15,000, $20,000, $30,000 in credit card debt that they do have piling up. That's anywhere from 10, 15, 20+%. So that's what I'm going to talk to you today about, how to leverage your home, use the equity that you have created in buying a property in the last 5, 10 years. So congratulations, you made a very good decision. And then show you how to save money each month and how to pay down your mortgage even faster than the rate that you currently are with your current monthly outgo. So let me give you a quick example here. So the average consumer has about $15,000 or so in credit card debt for the ones that do hold credit card debt. And I did an example here really quickly with a consumer that has $25,000 in debt, just so you get an idea. A lot of people have a lot more, a lot of people have a lot less. Obviously these numbers are for informational purposes only. To figure out what is exactly right for your situation, you'll need to give me a call. I'll give you that number here in a little bit and we can work on a free financial proposal for you. But let me start here really quick. So, did an example. So somebody buys a home in 2010. Congratulations, you made a wise decision. 2010 was a great time to buy a property. Your purchase price was $200,000 and you got in at a smoking rate of 3.5%. So, great job. So now fast forward to 2017 where we're at. So, assuming normal appreciation and kind of what we've been seeing over the few years, your house now is probably worth about $350,000 or so if you're in Arizona, California, or Washington, some of the other areas that we service. With normal pay down of you making normal payments on your mortgage, assuming you didn't do a cash out refinance already, your principal balance is probably around $150,000 or so. So just easy numbers to work with. On a cash out refinance, you're able to take up to 80% out in cash of what your property is worth. So in this instance, if you owed $150,000, you want to take up to 80% of cash on your property, you'd have about $130,000 available for you to access to pay off debt or whatever else you want to do with it, home repairs, things of that nature. So to break it down for you, I have a typical consumer that's carrying around $25,000 in credit card debt, and looks like they have about 6 credit cards here. And so first credit card has about $10,000 balance, the minimum payment's around $450 or so. As you guys know, if you're making anywhere near the minimum payments, they're not going anywhere. So if you're making minimum payments, estimate time for you to pay off your credit cards about 26 years, so about the same time as a mortgage. So if you're making those minimum payments on these balances, it's going to take you about 26 years or so to pay off, and that's assuming you don't add any additional debt on there. So second credit card, $8,000 balance, minimum payment probably around $300. Third credit card, $7,000, minimum payment around $250. Fourth credit card, $5,000, minimum payment about $180. Fifth credit card, $3,500, minimum payment about $75. Sixth credit card, $1,500, minimum payment is probably around $30 or so. Your total monthly minimum payment outgo with this situation is $1,285 a month in minimum payments. So take that, add it onto your current mortgage payment. So your current mortgage payment at 3.5% would be around $898 a month, and that'd be principal and interest. Obviously your tax and insurance would be on top of that. Your total monthly outgo, principal and interest, and minimum payment on credit card debt would be $2,183.09 per month. $2,183.09 per month. So on the new proposed loan, you're going to leverage the equity in your home. You're going to take $25,000 in cash out to pay off this credit card debt and be debt free in a couple years, and I'm going to show you how to do that. So the new proposal, you take the $150,000 balance plus $25,000 cash out in credit card debt. Your new loan amount would be around $175,000. So 175 at a 4.5% interest rate, and by no means is this a credit extension. It's just used for an example to figure out exactly what you qualify for. We need to go through the application process, and I can handle that for you. But just as an example, we use 4.5%. Your new payment on all of that would be $886.70. Let's go up here really quick. So $2183 on your current monthly outgo minus $886.70. Your new monthly savings, if you're making your minimum payments, which most people pay more than their minimums, would be $1,285 per month. $1,285 per month is currently what your 3.5% interest rate is costing you by not taking advantage of the money that is out there for you. So people say, well, hey, you know, I've been in my house since 2010, it's 2017, I paid down 7 years of my note, I don't want to restart and all of that again. I totally understand that, and I understand where you're coming from. So if you continue to make the same monthly payment, which you already know that you're able to make because you've been doing it, and most people make more than the minimums, but just go off the fact that you're making that minimum credit card payment, take that and apply that to your new mortgage. So you'd be paying a new mortgage payment, which you don't have to pay, but you can, of $2183.09 to the new mortgage payment. You would have your house, all of your credit card debt, everything paid off in 7.96 years. You'd be debt-free in 7.96 years by consolidating that debt and doing a cash-out mortgage, saving you over $110,000 in mortgage interest alone. Now, doesn't that sound a little bit better than, you know, I'm at the water cooler, I have a 3.5% rate. How about being at the water cooler telling everybody I'm going to be debt-free in 7.96 years? What about yourself? So for more information, to have a private scenario, a financial plan worked out for you, give me a call directly at 480-203-6263, 480-203-6263, or shoot me an email, Ryan, so R-Mandley, R-M-A-N-D-L-E-Y at afncorp.com, R-M-A-N-D-L-E-Y at afncorp.com, and you can always visit us online at www.dreamhomefunder.com. There's a lot of information on there. Click the Apply Now tab is the fastest way to get a free review of how much money that we could save you and put your family in a better financial situation in the future. Thanks everybody, talk to you soon.